Hey everybody, happy Thursday, November 9th. It's about 10:30 on the West Coast and time for another market updates. Going back to last week, we had a nice rally going. And on Friday, we were getting a big October BLS jobs report. We wanted that to come in our favor to keep that rally going. Rates had dropped from about 8 to about 7.5, and it did come in our favor. It was expected to add about 180,000 jobs, only about added about 150,000. Unemployment rate went up. They made some negative revisions. So let's take a closer look. As a reminder, there's two different parts of these jobs reports for the BLS. There's the business establishment survey, which is done with a lot of mathematical projections, and then there's the household survey where they actually call people. So the business establishment survey is where they get these headline number from, and again, that came in underestimate. They made negative revisions, which we'll get into in a second. Average hourly and weekly earnings slowed down, which is good for wage inflation. And then another thing I want to touch upon, these average weekly hours dropped from 34.4 to 34.3. The high was, I believe, 34.8. So that's gone down about a half an hour, over about, I believe, 6-7 months. And that doesn't sound like a big deal, but if you exploit that out over the 160 million workers in our economy, that adds up to about 2 million job losses, full-time job losses. So again, looks like a little tiny increment, but that is a sign of weakness in our overall labor economy, economy. And then, like I said, the next thing I want to look at is these seasonally adjusted revisions they've made. We talked about this before. It's a little frustrating. So this number over here is the first number that they report, and the market reacts off of. This 517 last year killed us. We were just under 6% rates, jumped up to close to 7. All these numbers come out really big, and for the most part, then they get revised over a couple different times lower. The only time it's gone up over time is July. You look at August. August, we came out 187. Then last month, when they released the September number, they positively revised August to 227. And then this month, they negatively revised it down to 165. So it went, it was 187, went up, then down. So it's all over the place. September was a big number. This killed us. This was not good for mortgage rates, 336. They've already dropped it down to 297. Probably going to come down more. So it's just a little frustrating here. Like I said, every month except for July, they basically negative revise lower, markets react, and then we don't get that same positive reaction as much when they do these negative revisions. Next part was this household survey part. So that's where the unemployment rate comes from. That jumped from 3.8 to 3.9. And then point out the jobs number, this total labor force, basically total jobs dropped, full-time jobs, total labor force dropped. So total labor force, this is people on unemployment for too long, dropping out of the labor force. And so if this number wasn't so low of a drop, this unemployment rate would have probably gone up to 4%. Multiple job holders is up 205,000. That keeps being added. So that's people having to get second jobs to make ends meet. Again, not the strongest indicator for how people are doing. And then let's see here. The next thing we got was the initial job claims. Initial job claims, connecting back to this job stuff with the Fed and whatnot, came in at 217,000. Still really tight. Not a big number. 215 was the estimate. 215 to 220. Continuing claims jumped. So basically shows that people are having a hard time finding a job once they lose their job. But employers are trying to hold on to employees as long as they can. And it looks like they're cutting hours too, based on that dropping. Appreciation. So let's take a closer look at this. Black Knight and CoreLogic both showed gains in September. As we can see, Zillow had a drop, but they're showing gains. We haven't got Case-Shiller and FHFA yet, but overall we're on about 6 to 8% across the board 2023 pace. That might slow down a little bit as the year goes on, as we end the year here, because next seasonally tend to slow down, but still a far cry from people calling for 10, 15, 20% drops in home prices going into this year. Next thing we got, I wanted to spend some time talking about, rates into home prices during recession. And you're going to start hearing that word recession more often. And the reason that is, why analysts have been kind of predicting this is our economy tends to go into like a boom bust cycle. So, basically, as we saw over the last couple of years, the Fed tends to keep rates too low for too long. Economy gets really hot, inflation gets really hot. The Fed says, hey, we want to, stop inflation, so we got to kill demand, so we want to raise rates. So they raise rates, they try to kill demand, which we've seen, in mortgage and in housing. And then at that point, inflation starts to go down, but it's really hard to kill demand without slowing down our economy. If you tell all of us to stop spending money, then we stop going to restaurants, we stop doing things. So that, ends up costing people jobs. So then at that point, the economy slows down, we go into recessions, and then the Fed says, hey, we need to stimulate the economy. We're in a recession. So then they cut rates. And then we start that cycle all over again. So that's why generally, why we go into those recessions, based on basically how the Fed runs things, which, we can talk about another day. But, and then, right now the reason people kind of think we're going to go into a recession, there's things like recession indicators. The most common one being 2 straight quarters of negative GDP. That is negative GDP growth. That is a recession indicator. That already happened, but they didn't call a recession then. It happened 2022. But here's another one. Unemployment rate spiking 0.5%. So the low our unemployment rate was at this cycle was at 3.4 in April. We're up to 3.9, like we talked about. So that's 0.5%. As you can see over the years, it's been pretty reliable. Either you throw out this 1948 number back in the day, but within a couple months, negative or positive, once we see that unemployment rate go up 0.5 point below above its low, that's a good recession indicator. So as you can see, right now we're at that point. So sometimes they say, hey, it's a month down the line. Sometimes they say, hey, we were already in a recession for a couple months once the NBER says we're in a recession. But just something to keep in mind that a lot of indicators say we're going to recession. So how does recession affect housing? We've talked about this before, but generally housing does pretty well in recessions. So this white line is the Case-Shiller index, the home price index. As you can see, every recession, it kind of either stays flat or goes up slightly, or except for 2007 through 2009, but that recession was caused by housing. We're in a much different scenario than we were then. Borrowers are stronger. Our industry is a lot better about, qualifying people. People have a lot more equity than they did back then. Back then there was about 4 million homes available nationwide for sale. Right now there's about 1.1 million. So completely different environments. So as you can see, in general, housing prices stay strong through recession. So if you're an owner, you're looking to buy, that's something to kind of keep in mind if the thought of a recession coming up is something that scares you. The second part of the equation is, how do rates do in a recession? They do pretty well. As you can see, and this goes back to what I explained is that, we go into recession and then the Fed cuts their rate and that makes mortgage rates come down. So as you can see, basically every recession they've, they're gone up going into it or go up during it. And then during the recession, at some point when the Fed cuts rates, you see mortgage rates drop pretty quickly. Right now we're kind of about right here, but that's just something to keep in mind, as we go into, some economic uncertainty over the next couple of months and see what happens. Next thing, so average conventional, we're about 7.5. It actually hasn't updated today. Not the best day today, but we had dropped down to about 7.38. Kind of gave some back over the last couple days, got some gains here and there. So let's say about 7.5. So good to see we didn't give back, kind of what we dropped over the last week. And then some important dates. We got, CPI next Tuesday. So inflation, that's an important one. We got another one in December. We got another PCE, and in November, got another BLS jobs report in December. And then we got that Fed beginning December, with their next rate hike announcement. We'll see what they do. Right now, the markets are saying they're not going to hike again. That's what we want. And then hopefully cut early next year. So just want to wish everybody a happy Veterans Day. If you served or any of your family or friends served, thank you what you did for our country. And if anybody needs anything at all, please don't hesitate to reach out. Have a great day, everybody.